something that is very approachable and anybody can do. And what frustrates me sometimes about finance is that everybody in finance has got a vested interest in making it sound really complicated.
Steve Clapham, he is a 25-year veteran as an investment analyst for hedge funds. He managed and helped hedge funds do the research to buy the investments that they did. 25 years. Matter of fact, he's got a ton of awards, and those awards are Most Accurate Forecaster Award. You want some information from somebody that was awarded the most accurate forecaster for hedge funds? He's also been featured on Bloomberg, BBC, Financial Times, Business Insider. He's been on the buy side of 2 multi-billion-dollar hedge funds. He's written a book, The Smart Money Method, How to Pick Stocks Like a Hedge Fund. This is somebody you need to hear about because he and I are going to get into the weeds on how he helped hedge funds make sound investment decisions. And we're also going to get into the economy today and what you need to be doing. So stay tuned. This episode is sure to be one that is timely and informational. How did you get into this? Like, what was your journey like? How did you land in the capacity of doing analysis for hedge funds and working in the markets?
Well, I wish I could say, like Warren Buffett, I saved my money as a newspaper boy and invested it. But actually, the stock market was, so far away from my upbringing. My father was a very conservative guy, never borrowed money, didn't have a single investment. And, money in the bank was what his philosophy was. But I had been a management consultant and I was working in the Netherlands, in Holland. And my then boss was based in London. He said, look, I need you to come back to London to do a project for us. So I came back to London and the project it's a long story I won't bore you with. There's a guy called Eli Goldratt, and he wrote a book which Jeff Bezos gives to his lieutenants. And wow. Eli wanted to build a system around this book. And I was the guy that was going to do the accounting side of it. But long story short, the project never got off the ground. I was becoming more and more expert in a very, very narrow field. And I thought, this is quite dull. I've got to do something else. So I got a job. I got offered a job. I was interviewed by the CFO of the 5th largest company in the UK. So I was 26, so it was quite a high-level job, reporting to CFO. And I got the job, and they called me. The guy that I was going to be working for called me up and said, "Oh, Steve, bit of a problem. Personnel department pointed out you're too young for this grade." So I know, pardon. So he said, "Look, no, you'll be doing exactly the same work. You'll just get paid a little bit less, and you'll have a slightly different car." And I said, "I'm sorry, I'm not interested in working for a company where you've got to be a certain age to progress." Can you imagine? Okay, this is a long time ago, right? So it's not a recent thing. But I was recanting this story to my brother-in-law. And my brother-in-law said, well, why don't you go into the city? So the city being Wall Street. And I said, don't be stupid. I don't know anything about the Wall Street. He said, well, how would I do that? He said, well, I don't really know. But my secretary, her husband works in Wall Street, works in the city. Why don't you go and have a coffee with him? And I said, well, would he do that? And he said, well, I'll call her now. So he called her up and she said, oh, yeah, I don't even need to ask Bob. Of course he'll do that for you. So I was thinking, oh man, this guy's wife has arranged a meeting for him. How well is this going to go? I went in to see the guy, and I showed him my CV, told him what I'd done. And he said, well, why don't you come and work for us? It was the easiest interview I'd ever had. And so, but, I could not even spell PE. I knew nothing, absolutely zero. The only thing I knew was how a balance sheet worked, because I trained as an accountant. But at the time, we were going through deregulation in London. And so it'd gone from being a closed shop where you had to go into certain school and you had to be in the army, and it was a very traditional thing, to opening up to people. I went to a grammar school, and they were like, oh man, this guy hasn't been to boarding school. It was a real upper class and lower class kind of distinction. Obviously that's ages and ages ago. And so I came in completely by accident, but because I had the accounting training and because I used to be a management consultant, so I worked really, really hard. This was a time where the guy I sat next to was a traditional stockbroking type who was complaining because he used to come in at 9:30, go for lunch, have a couple of bottles of wine at lunchtime for 2 hours and go home at 4:30. And I was, I was used to working proper hours, right? So I did a lot better than, than incumbents. And so I did quite well. And I was on the sell side for about 15 years. And then one of my clients said, well, why don't you come and work for me? And that was, a big hedge fund. And when I started doing the investing, I thought, oh God, why didn't I do this before? Because I really enjoyed it.
So there's one thing you said in there that was just so in line with everything that I ever had an experience with. So when I first got into Wall Street, I was 23 years old. I was a young, kid there. Basically, I was a pro snowboarder. And I remember I got into the firm and I was in the bullpen in the middle. And I looked around to all the glass cubicles. And just like you said, that stockbroker type, all these guys showed up at 9:30, sometimes 10 o'clock. They'd leave for lunch for no less than an hour and a half. Yes, they'd come back. Some of them, probably had a little buzz on, and they were gone by 4:30. So me being a guy that grew up in a lower income household and always had to work for every darn thing I had, I looked at this and I said, this is a massive opportunity. These guys are just not putting in the time, and they're the guys with the big cubicles making millions of dollars. So if I want to get that glass cubicle, all I need to do is do what every one of these guys is unwilling to do. So I got in at 7 a.m. I got all my stuff ready. I made, a plan for each day. I worked through lunch, and after 4:30, when the place was a ghost town, I stayed and I dialed. And then I went out and I saw people at their kitchen tables. And that's how I became one of the top advisors for that firm. It wasn't a hard formula, Steve. It was kind of just like, my gosh, these guys just aren't doing it and they're making it. So all I got to do is do a little extra. You mentioned that, and I love that.
Lots of us new guys coming in, we outsmarted the incumbents and we outworked the incumbents.
Yes.
So I wouldn't say it wasn't easy, because obviously you've got to overcome the hurdles of those long established relationships.
I want to talk about how most people are getting the advice and how most people are reacting to buying stocks and putting money in their 401ks. We kind of talked offline a little bit about like Uber drivers or cab drivers. A lot of people will make investments. I don't care if it's crypto investments, NFTs, or stock picks, because their Uber driver says, oh, wow, you should really look into this one. It's going to the moon. And I find that absolutely ludicrous. I feel like it breaks every single rule that I've ever had with investing. And I'm sure it kind of just makes, the hair on your arm stand up, because that's not how hedge funds buy.
I mean, it's a remarkable thing, but there is a taxi driver in New York who was featured in the Wall Street Journal. And, I got into this cab. I used to go to New York probably once a quarter, or go to the States once a quarter. I usually traveled in via New York and went to see some of the Wall Street firms. And then I would go out and visit companies that either we were invested in or looking at investing in, or go to a conference, whatever. And I got in this cab, and I normally like to walk around, but it was a hot day, and so I got in the cab, and the guy said to me, so what do you do for a living? I said, I work for a hedge fund. And he started interrogating me. He went, so what stocks are you looking at? What do you think about this one? What do you think about that one? And after about 10 minutes of conversation, I said to him, so, excuse me, why are you asking me all this? And he gives me a laminate. And he was the guy that was the cab driver that was featured in the Wall Street Journal for having such a good stock performance. And what he'd done is he'd been sitting there listening to the people talking in the back of his cab. So he used to work Wall Street and used to listen to the conversations, and he used to pick up stock tips. I mean, I guess he must have been quite a skilled stock picker, because you couldn't just do that. And he'd been quite successful, and he was incredibly knowledgeable. I mean, it's not very usual for New York cab drivers, but if you talk to cabbies in London, I don't know if you're familiar with the system, it's falling by the wayside now because of Uber and we all have maps in our phones. But in the old days, to become a cab driver, you had to do what they call the knowledge, and it's a test. And in order to prepare for the test, you would go around London on a moped or a motorcycle for 18 months or 24 months, learning all the streets. Because the test is, the examiner says, okay, you're picking me up from Buckingham Palace and I want to go to Hampstead, such and such a road. What route do you take? And it can be from anywhere to anywhere, and you've got to tell them what route you go. So as a consequence of that, taxi drivers have got an incredibly trained brain, because they've trained their brain to memorize all these things, and they're super smart people. New York, not quite the same. If you get one that speaks English, you're doing quite well. But it's an interesting subject, because I think anybody can be a successful investor. Investing's not, it's not that difficult. The actual intellectual challenge, it can be difficult at times, and there are things that can be very difficult, but you can get 80% of it without being super smart. You just need to use your common sense. You need to understand the basics, and then you need to be in control of your own emotions, which is probably the hardest thing for new investors to conquer. But I have an online training school, and behind the balance sheet, we've been doing this now for 2.5 years. We've been training people online, and one of the things we say is, look, this is not you don't need to be an intellectual genius to make money in the stock market. But what you do need to know is you need to understand the basics of finance. You need to understand how to spot a good business, and you need to understand a bit about valuation. But it is something that is very approachable and anybody can do. And what frustrates me sometimes about finance is that everybody in finance has got a vested interest in making it sound really complicated.
Absolutely.
Because if they make it sound complicated, they can extract money from you. And that's what the whole system is. The whole system's rigged. The whole system's rigged so that Joe Public has to pay fees. And it doesn't have to be that way.
Oh, Steve, you have no idea. We're going to be good friends, because what you just said there sums up every single thing I talk about today. I talk about people taking back control of their money, and this audience is very used to hearing me talking about that. But I talk about that because exactly what you said, the system is rigged. It is so one-sided. When I worked in Wall Street, everything that I was taught from the analysts, from the consultants, was always one-sided: to sell a product, sell a commission, charge a fee. So we were taught about the whole markets, but we were always taught to pigeonhole people into the one thing that paid us the most or paid the brokerage the most, which does not mean it is the best suggestion for the client. And it took me, unfortunately, 16 years to kind of see that. And I didn't see it until I got into the RIA space, where I was managing our own portfolios, working with some of the people in the dark pools and some of the hedge funds that we would offer through our different portfolio makeups, where I saw the breaks in this whole thing. And I'm thinking, wait a second, they do things completely different than how I've been taught to do it. And then I started seeing that the wealthy and the family offices did things very different. And the only difference that I could determine was, one side, they were making recommendations and suggestions that paid them. It was self-serving. On the other side, the family offices and the hedge funds, they were doing the research, the due diligence to make sure that what they recommended to that family office or to that hedge fund, person that was in charge of the buys and making the purchases, had fundamentals, had actual basis, had an actual chance of making money based on research. Your podcast, Behind the Balance Sheet, does it. And your book, I got to give a shout out to your book. I kind of glanced through some of the things. I didn't read the whole thing yet, but The Smart Money Method, folks, you guys all have to get this book. How to Pick Stocks Like a Hedge Fund Pro, chosen as the prestigious Starman most accurate forecaster. You don't forecast looking in the rear view. Sure, you analyze looking in the rear view, but let's get into it a little bit. Like, how do you look at risk when you're looking at an investment opportunity? It doesn't have to be a stock, but any investment opportunity. How do you look at risk, and then how do you weigh that to the return? And what are some of the things that you would look at while picking for a good investment?
I mean, it's very interesting because obviously in the last couple of years, people haven't really been bothering about risk. And, you know, I'm not the person that's going to be the best performer in a raging bull market where valuations are going through the sky, because I'm far too conservative. I'm far too concerned about the downside. Because my starting point when I look at a stock isn't how much money can I make. My starting point is what can I lose? And so what I try and teach in the school and what I try to emphasize in the book is always start with thinking about, well, what could go wrong? Because the easiest way to make money is, first of all, worry about not losing it. Because once you've lost money, it's very difficult to recover. And, you know, you lose 50% on a stock, you've got to make 100% to get back to where you started. So I always start off with, you know, am I buying something that's got either a high degree of financial leverage or a high degree of operating leverage? So I always think about, you know, how resilient is demand? How steady has turnover growth been in the past? Has it been a very cyclical business? Has it been a very volatile business? That's not to say, you know, I'm happy to buy cyclical businesses, provided I feel that we're at the right point in the cycle and that I'm paying the right amount of money for it. I actually like buying cyclical businesses, and I like doing recovery type plays. But you know, my driving imperative is always to think about, okay, what could go wrong? And then, you know, in order to find a decent stock, you need a couple of things. You need some reason to believe that it's going to be growth. You need some reason to believe that somebody's going to pay a higher price. And I don't really invest on the basis that there'll be some fool that'll pay an even higher price than the high price that I've paid. I kind of like to feel that I'm paying the right valuation, the right fundamental valuation for the quality of business that I'm buying. And I don't like to pay, you know, very high multiples of sales. You know, I was looking about a couple of months ago, a client asked me to have a look at a stock in Europe called Adyen. And Adyen's a competitor of Stripe. It's a payments company. And, you know, the rumors of Stripe coming to the market at an outrageously high valuation. No, so, I mean, these payments companies are, don't get me wrong, they're very, very good companies. And, you know, every time I sell a course on my website, Patrick Collison at Stripe is taking, you know, $1 out my back pocket, more than $1 out my back pocket. And he's got a very, very good business. But the company I was looking at called Adyen had sales last year, if I remember correctly, 1.35 billion euros. And it was valued at $100 billion when I looked at it.
What kind of a multiple does that work out to be?
80 times sales.
That's insane. That's just, anyway, I'm not even going to say anything more.
You know, it's obviously a multiple that would be very hard to justify. It so happens that this business has got a very large runway for growth, but in order to justify that, when I did the sums, I said, okay, could this company grow at 40% per annum for the next decade? And actually, that is a realistic, I mean, it's not an impossible task. And I said, if it could do that, then in 10 years' time, it'll look fair value. So I mean, you're not going to make any money in this. I mean, even the best possible circumstances, it's hard to see how you would make money in it. But, you know, I could understand how it got to that level. I could kind of engineer, but, you know, it's not a small, you know, it's still got €1 billion, you know, $1.5 billion of US of sales. I mean, it's not like a $10 million company. So, yeah, I mean, the valuation is very, very, very difficult to justify. I mean, and I haven't looked at it recently. I mean, for sure, in the fallout we've had, the overdue fallout we've had at the start of 2022, I'm sure the share price will have corrected quite a lot. But my thing isn't to buy stocks on outrageous valuations and hope that somebody else will pay something even more. My thing is to buy stocks that don't have an outrageous valuation, and ordinarily I sell them before the valuation gets outrageous.
Because you're smart.
I normally sell too early because people get over enthusiastic about some of these things.
But I got to comment on that. Is there really a such thing as selling too early when you make money? Like I talk about this all the time. People ridicule me. I'm incredibly conservative in how I invest. Matter of fact, like right now, I have zero stocks in any of our portfolios, including our hedge fund. We have some private positions in companies, but zero stocks, none. I don't want them because nothing that we've looked at, and literally I just can't devote any more time to look at anything, makes any sense fundamentally. And you kind of look at that, you take that back to Warren Buffett, like he's one of the greatest long-term investors, and he's a very conservative investor. He shies away from lots of opportunities and could have made lots more money. He says that every time he's on a show, he says, I could be way wealthier than I am. A lot of people, you're already one of the wealthiest men in the world. That is only because he's been investing for longer than everybody else. I mean, literally, like when you look at his success as an investor, yes, he's a fundamental investor. He had good mentors and he does a very good job, doing his due diligence and research, but he's just in it for the long haul. He's been doing this longer than just about anybody else. And time is one of the greatest things for any investing. But I guess I was going down a bit of a rabbit hole there. Let's move into right now. We're in 2022. Most people don't even understand this. So this is maybe, most people just ignore this, but they really shouldn't. When we look at the cycles and we look at the markets as a whole, and we look at the patterns, and we go back to any cycle, I don't care how far back you go, 1500s, this is it. We are at the end of a long-term debt cycle. We are at the end of a capital cycle. We are at the end of the technology cycle, actually long overdue on that, and at the end of a short-term debt cycle, which is even a couple of years old. And here we are in 2022 with the craziest government, printing press spree that we've ever seen, where they're just creating more and more debt, and nobody's paying attention to this. I mean, I can't imagine, Steve, that if you took any stock that any cab driver gave you, you'd be able to look at it and say, yep, this thing makes perfect sense from a fundamental basis. I mean, if you know how to read a balance sheet, how can you support any valuations? I mean, Rivian and several of these electric car companies, they're worth more than some of the huge car companies that have been in business for decades or even centuries, if you go that far. And they're not even worth as much as a company that hasn't sold one car. How does that make any bloody sense?
I mean, I agree. I mean, the electric vehicle space is one of the most overvalued, outrageous areas of the US market. And I can't really understand why people are willing to pay up these multiples. I mean, I think it's really stupid because in the electric vehicle space, you've got a whole incumbent industry. And it's not as if that incumbent industry is full of loser companies. Those companies haven't been highly regarded by the stock market. They haven't made huge returns because there's, far too much capacity in the automotive industry. But the participants are highly efficient, well-managed businesses. And the electric vehicle manufacturers, the new disruptors, I think are going to get a bit of a fright because, it's going to be a very crowded, very competitive marketplace in which there'll be even more capacity and, nobody's going to make brilliant returns. I mean, Tesla have done well. The valuation doesn't make any sense to me. But there are still, I think there's still pockets where there is value. And, we're in a very difficult environment. And, I think it's going to be very hard to make money in the stock market over the next 10 years. And, people say, oh, well, stocks are your friend and they've made 8% forever. But, we've had, 10, 12 years of extraordinary performance. So I think, you have to moderate your expectations. And particularly for some of the more inflated corners of the stock market, you're going to lose money, and that's what we're seeing at the start. But I find it quite possible that a stock like any of the big tech companies, whether it's an Alphabet or a Meta, in 10 years time, they're going to be making more money, more profit. And, even if they suffer a bit of derating, I think you'll still make money in those stocks. And I think the issue here is, what else are you going to do with your money? And that's really the problem, because unless you believe that in an era of financial repression, that savings will be forcibly directed to government bonds, and there's a very credible argument in favor of that. I think that's quite a radical argument. I think, when I look at it today, what would I do with my money? I mean, there's some areas where you can kind of get some protection, but having good stocks is probably as good a strategy as anything. There's an argument that you can make in favor of certain elements of the property sector. There's an argument you can make in favor of commodities, for sure. But at the end of the day, for most people, finding good stocks and is still a coherent strategy. And I can still find some stocks that maybe aren't, outrageously cheap, but they're sensible value. And I believe that over the next 10 years that they're going to grow sufficiently. So even if there's a bit of contraction in the overall valuation of the stock market, I think my money will be well protected, it'll be inflation protected, and I'll get a return from those. I'm not expecting, I'm not expecting 8% per annum as my benchmark, right? I'm expecting something very much less than that. But, as long as I keep up with inflation and maybe make a bit, and if I'm smart on my stock selection, maybe a little bit smart, a little bit cute in my trading, then I'll be fine.
I love it. And going back to something you said earlier, where it's a lot of times you sell too early and you take your gains off the table. And I had mentioned, I don't know how you can make that mistake, but we both get ridiculed for it all the time. Why is it that people have such a difficult time? I mean, they all understand to make money in investments, or at least I hope they do. The name of the game is what Warren says: buy low, sell high, and don't lose money. But that seems such a simple strategy, and a strategy that too few people follow, because people just love, I mean, you can see it from the crypto space and Bitcoin. People love to buy high because it feels good. They're participating in the FOMO. And then what do they do when it drops? Well, we just saw it. They love to sell low because they get scared. And then they repeat the cycle. It goes back up, they buy, and then it comes back down and they sell. And listen, like it's easy to see how hedge funds and big, experienced investors make money, because when other people are selling, they're buying. They're being greedy when everybody's fearful. But why is it so difficult for people to just understand that you're never going to get it right on the top? You're never going to get it right on the bottom. So when you're in a gain position, just set rules and sell and take your gains off the table. Where do you see the disconnect there in this market?
I mean, I don't know. I mean, I'm probably not the best person to form a judgment of this, because, when I was at the hedge funds, we were often guilty of buying too early. One of the difficulties is if you're involved with a portfolio, a multi-billion-dollar portfolio, your position size has to be very significant. You can't wait for the stock to turn, because you can never buy enough. And similarly, on the selling side, if you wait for it to peak, you can't get out. So you've got to buy it. So if you think of a stock going like that, you've got to buy it on the way down and hope you're not too far from the bottom. But you never know, right? You never know where the bottom is. And similarly, when you think you've reached fair value and it's gone a bit beyond fair value, you start to trim the position and you gradually exit out, because you can't get out in a day. If you've got a position that, and the stocks that I was responsible for, we would have very, very significant positions. I mean, some of the positions we had declarable stakes in companies. And when you've got a position that's $100 million or $200 million or $300 million, you've got to be very patient in getting in and getting out. But for the average person, your question was, why do people do this? And it's just a psychological issue. As I said at the start, the investing part of it, it's not, I mean, it's straightforward. It's not complex, but you need to understand the basics, right? But those basics, with a bit of effort, doing a course, reading books, watching what's happening in the stock market, you can learn that. The most difficult thing is learning to manage your emotions, not getting caught up in the hype and not getting too depressed when things go down. And, you know, it's not, I mean, that part of it, even for me, having done this for decades, it's not an easy thing to do. You know, it's hard. And if anything, I think the selling is harder than the buying. You know, often I'll see an opportunity, and I did this last week. So I don't know if you're familiar with Unilever. Unilever,
the company like, Unilever.
Yeah, it's like Procter & Gamble.
Yes.
So it's a similar company in Europe. It trades at a big discount to its peers because it's not nearly as profitable. And under its current management, it's been a bit undermanaged. But it's got some fantastic businesses. It's represented in some of the big growth areas of the world. It's got a very big business in India, Hindustan Lever. It's got a very big business in Indonesia. I mean, these are countries where they've got very, very low per capita income, but the per capita income is increasing. So instead of selling, you know, they sell things like soap or shampoo. So instead of selling a jumbo-sized American bottle of shampoo, they sell sachets of shampoo in these countries. But it's still a great business because they've got a good brand. And as those people who can only afford a sachet today go up the income curve, in 20 years' time, they'll be buying bottles of shampoo. So, you know, it's got a very, very good long-term runway. And last week, the stock really cratered because the management said that they wanted to make an investment, and they were going to bid 50 billion sterling. So what's that? That's about $67 billion for Glaxo's consumer products arm. I mean, well, we don't want them to do that because they haven't managed to get the margins of their own business up. So, you know, paying a big multiple for somebody else's business is only going to give them more problems. And so there's a big revolt against the management. And I looked at this and I thought, Unilever is at a 5-year low. The valuation's not dirt cheap, but you never buy a high quality consumer brand business for a single digit multiple. I mean, these things are rightly very expensive, highly rated companies. I thought, you know what's going to happen here is that their management are going to be under severe pressure. And the most likely thing is that there'll be a change in management. These investors are fed up. The CEO has been there for 3 years. The share price is lower than it was when he started. And every other consumer products company in the world has been re-rated. So I bought some stock. And this is not an investment recommendation. This is me investing my own money. But, you know, those sorts of opportunities, I think, you know, I see them and they're very easy to take advantage of. Now, it so happened that in the Financial Times yesterday morning, Monday morning, we're speaking Tuesday, it was revealed that Nelson Peltz and Trian had taken a stake in Unilever. And the shares were up.
Oh, there you go.
I don't know, I think they were up 7% yesterday. So there's carnage in the stock market and Unilever's up. And, you know, it's relatively easy to find opportunities like that to buy. But you're going to ask me, well, when am I going to sell Unilever? And that will be a much more difficult decision because selling out of a high quality business, and that, you know, I'm expecting that stock to go up 30, 40, 50%. But the sale will be psychologically much more difficult than the purchase. Because I bought it, I've got no emotional attachment to it. I've looked at Unilever many times. I've never owned it myself. here's here's an opportunity. I'm going to buy the stock and hold it for, I don't know how long, but 30, 40, 50%. But when it comes time to sell, I know that I'll struggle with a sale because I think, oh, Unilever, it's a good quality business. It's got good brands. It's grown its dividends by, I don't know, 6% real for 50 years. You know, the numbers are all very, very persuasive. It's got brands that are 120 years old. And I'll find the sale much more difficult than I found the purchase. And that's just, I think that's just the nature of things. I don't think I'm particularly unusual. I think everybody goes through that same struggle because once you own it, you form an emotional attachment
100%.
to it. So cutting that attachment is psychologically more difficult than it is creating the attachment. It's just more difficult to sell things than it is to buy. I found this at the hedge funds. I found shorting was much, much more difficult than being a long only investor. Easier to be unemotional when it's other people's money, because you know you've got a job to do, you've got a fiduciary responsibility. That's your job, it's your profession. Easier sell discipline, but I always found the shorting was much more difficult than the long only side.
Yeah, so I agree with shorting, and you know I've gotten shorting wrong too many times to count, which is why I have a full-time trader that manages all the portfolios to take that emotion out. Because I often, being so pessimistic about the markets and where we're at in the cycle, that I tend to want to short everything. Matter of fact, just yesterday I made some money in shorts, but that's neither here nor there. But the other thing too, in your book, do you teach people like how to do this, whether it's a short investment, maybe they're just getting into something for the short run because they think it's a good short-term investment, or a long-term investment? Does your book cover a lot of that?
Well, the focus of the book is more long-term investing. I mean, I don't see myself as a trader. I mean, obviously, when you're running money professionally, then there will be an element of trading, because if you see a short-term opportunity, then you take advantage of it. And obviously, if you can recycle short-term gains, then that enhances the overall return in the portfolio. But at the end of the day, we were always long-term investors. I mean, both the big funds that I worked for had very long average holding periods, were very low turnover relative to other hedge funds. So it wasn't that we wouldn't say, oh, that stock looks really cheap, we'll buy it. It goes up 40% and we'll sell it. We would of course do that. And the faster it went up, the better, obviously, because you're enhancing your returns. But, trading is a completely different game. And, when you're deploying large chunks of money, we would spend, I wasn't doing only this. I mean, I was obviously doing my job, looking after the 15 or 20 stocks that I would have in the portfolio or under immediate coverage. But if I wanted to look at a new idea, I would spend 6 weeks. And I would learn everything that I could about that company. I would read every single analyst report that had been produced in the last 6 months. I would go back 3 years, look at sell reports. I would take the accounts apart. I would build my own spreadsheet with a detailed profit and loss account forecast, a detailed cash flow forecast, and a detailed overview of the balance sheet. I mean, I would go into incredible detail. I would spend time with the management of the company. I would go and visit them. Usually would visit a company at their own office before actually pulling the trigger on an investment. Not always, because sometimes travel just didn't allow that. And I was a global investor. So, I didn't want to get on a plane every week. I mean, I used to travel to America, used to travel to Asia, I used to travel to Europe and travel a lot. But a lot of work would go in to the purchase decision. And if you're going to do that much work, you want to deploy the money over a long period and try and make consistent high returns. And, we're not looking to make 50% per annum out the fund. You're running a multi-billion-dollar fund. If you can do 15, 20, 25%, that's a great result. And your investors be very, very happy. For a hedge fund, so I'm not talking about the beta in the stock market. I think one thing that people get very confused about is they say, oh, these hedge funds have lagged the market. Well, of course the hedge fund's going to lag the stock market because you don't have 100% long exposure, right? So, if you're running in a bull market, you're running a 30% net long position and the stock market goes up 30%, you should only make 9%. And the difference between 9 and the 20 or whatever you come up with is the actual skill that you've deployed.
I love that. I absolutely love that. So, after COVID, you write about this at the end of your book, but, after the COVID happened and, the pandemic really hit, it changed the landscape of investing. A lot of new investors came in, you saw Robinhood skyrocket. You saw Reddit investors actually, do some impact on the markets and actually move markets in a way that I've never even thought possible from a retail investment standpoint, but it actually happened. So in your book, you talk about this, but what are your thoughts? Like, is that flushed through now? Like, do you think the investment landscape is different in today's world than it was pre-COVID? Or, what is your take on that?
Well, I mean, I actually finished the book in March 2020, and it was to be published in November. And I thought it's going to be really bad if I don't include a chapter on COVID, because it came out in November, and if it didn't have anything about COVID. So I just wrote the last chapter, which was 10 things to take away. And it was written very early on. So we didn't really know how long we would be locked down for. So it wasn't done with any great insight, to be perfectly honest. And, some of the things turned out to work quite well. I talked about issues like the supply chain. I underestimated the giant leap that the tech companies would make, the impact of things like Zoom, because I didn't know, I hadn't imagined that we would still be doing, we would be locked down for so long. But the landscape has changed, but I think the landscape has changed partly through COVID, but partly through a change in psychology. And you always get this at the end of a bull market. I remember 99, and I love America, right? So I used to spend a lot of time in America. I've got a lot of friends in America. And one of my very dear friends, sadly, David Lucari, sadly died. But I've got an interest in old cars. And Dave had a very amazing collection of old cars, hot rods. And one of the guys in the car club, Larry, had made money day trading the stock market. And he'd bought himself a new Winnebago. And Dave said to me, he said, Steve, you work in the stock market. Why aren't you giving me these stock tips? And I said, Dave, you are a welder. What do you know about investing in the stock market? Yeah, but look at Larry. He's got a new Winnebago. And I said, yeah, but Larry will be giving, the thing about Larry's been quite smart is he's taken the money, he's bought a new Winnebago. He's not carrying on. But I can guarantee you, if he carried on, he'd lose it. And, yes, we've got a whole bunch of new entrants in the stock market, but people forget you had this in 99.
Exactly.
It was exactly the same thing. This is not a byproduct of COVID. Obviously, cheap trading is a big factor. So if you're a school kid, you can speculate in the stock market. You can speculate in crypto. My kids, my elder boy at school, he said one of the kids is doing his crypto trading in class. And I'm like, so just to put this into context, my son is at one of the top schools in London. It's a fee-paying school. So the fees are over $10,000 a term. So they're $35,000 a year. So, the kid is not come from a poor family and he's trading cryptocurrency. And of course, he's losing money because you do well in a bull market, you don't do quite so well in a bear market when you're 14. But good, I mean, good luck to them. But I think the changes that we're seeing are predominantly the impact of the bull market, partly the impact of it being very cheap to trade, and therefore people who don't have a lot of money are able to get involved. And I think that's great. I'm all for the democratization of the stock market. And partly a technological thing, because of course, if you look at the tech stocks, that's where all the action has been. And younger people feel that they have a better understanding of tech and that they can actually see an opportunity. But guess what? All these Redditors, they're going to lose their shirts.
Yes, they are.
How it always plays out. But the irony of all this is that some friends of mine who are really good investors, including one very large investor, they've stopped shorting individual stocks because they can't take the pain, because they're shorting something that fundamentally is ridiculously valued, whether it's is AMC the cinema group?
Yeah, you could do AMC, you could do GameStop, any of those. They're just unreal.
And they're saying, well, hang on a second, we're getting carried out on stretchers doing this. Yeah. So 2 of my friends have stopped shorting individual stocks entirely, because whether it's Hertz or GameStop or AMC, they just can't take the pain. And that means to me, I was talking to a potential new client that's just started a short bias fund in London. And I said to them, well, I've never seen an opportunity as good as this for a short bias fund, because of course, there's no shorts around. There's barely anybody left shorting.
Yeah, it's very difficult. And, we were doing it a lot. We clearly were on the institution side when the whole GameStop thing was happening. We were shorting, and we ended up squeaking out a gain. It was pure, I call it pure luck, but it was near impossible. And it made every bit of logical sense and every bit of sense, from an investor, from our standpoint, much like yours, that we should be on the short side. That made no sense, but you just can't, you can never time what's going to happen. And the markets are just, they're bonkers right now. And that's going to continue until, the inevitable happens, like it has every other time in history. At the end of the cycle, everybody's going to lose their money if they're not protecting their wealth. And too many people aren't, because they're all just jumping in when institutions. And if you look at the hedge funds and you look at the big investors like the Berkshires and that, they're sitting on hordes of cash or hordes of US Treasury bonds, waiting for the inverse relationship with interest rates to happen. I mean, I've studied that. I've looked at where the wealthy are putting their money and what they're doing. And most of them, you can see a very common trend. They're selling out of lots of positions, firming up positions, hedging positions, and sitting on hordes of cash because they know what's coming. And I got 2 more questions before we go, because I'm just fascinated by this stuff and I could go all day. But what's your take on big institutions, lots of hedge funds, not all, but lots of hedge funds, and also some of the wealthiest individuals out there sitting on ungodly amounts of cash, which everybody else says is one of the stupidest places you can have money because of what some say is hyperinflation, but really which is just a rising inflationary period.
Well, I think the question about cash is quite a difficult one. I've always believed in having cash in the portfolio because I always think that it gives you an option value. I'm self-employed, so if I don't have any cash and I don't know next week how much money I'm going to make. If I don't have any cash, I'd wonder, how I'm going to pay the bills. So I think cash has a role in portfolios, but I'm not convinced that it's entirely the best place to have a lot of money over the next few years, because I believe that this inflation, obviously the current levels of inflation we're experiencing will be transitory. But I think inflation will carry on, and I think we'll find that we're in an inflationary period. And that's why I think you've got to look at equities as being one of your options. It's perfectly possible that we'll have a big correction in the stock market. But I think that, you've got one extreme end of the stock market, which has got very high valuations, which could fall a huge way. I mean, a long, long way, and drag the index down, drag the NASDAQ, drag everything down and make it look, oh, the stock market's a disaster. But in the same way as many, many funds underperformed last year because the gains in the stock market was so narrowly focused, I think you could have a bear market that's also quite narrowly focused. And I think you could be in, a commodity stock or an energy stock or a bank stock, and they could still go up. You could be in a bear market, but still make money in many, many sectors. And I think, what is going to characterize the next 10 years is it's going to be much, much more polarized. So it's going to be much more down to buying the individual asset. And that will apply to equities and it will apply to other categories.
But, again, every type of investing has risk, and you have to do your due diligence and have to look and see if it fits the needs and goals. So the last question I have for you, Steve, and thank you so much for your time. I know we're going a bit over, is there's so much talk about crypto and Bitcoin and NFTs, and they have no intrinsic value, no fundamentals really to speak of outside of maybe Bitcoin has a finite amount of coins. How do people look at that? Like, do you just say avoid them? I mean, what is your take on that space? Because it doesn't seem to be going away anytime soon.
Well, I've looked at this. I must confess, I haven't really understood why there's all these different cryptocurrencies. I've been studying it, I started to read up about it. I can understand that people believe in Bitcoin and therefore it has the value, whatever that value is. I've got no way of judging how, whether it should be 30,000, 40,000, 50,000 or 100,000 or 10,000 or $1. I can't judge how people value it. That's not my core skill set. I've been quite interested in Ethereum because I see that as being a more interesting play because I can see how it will be a vehicle for different platforms and that makes some sense to me. But whether it's ETH or Solana, those things I'm still trying to learn about. I have to tell you that in 2015, when crypto collapsed, I thought, what I'm going to do? I'm just going to take a bit of money and I'm going to lock it away and buy some cryptocurrency. And I tried to buy some. And in order to buy some crypto at that point, I had to open an account with a bank in Luxembourg that I'd never heard of. And when I found that out, I said, well, why would I do this? Because how am I sure that I'm going to get my money back? And then I looked at that, I said, well, I can see that if I bought some Bitcoin today, in 5 years' time, I could make a lot of money. But I can also see that I might make a lot of money on paper, but I might never be able to get it out of the bank that I've never heard of. So I did, to me, that was, there's a clear downside there that I don't like the look of. And I've never owned any Bitcoin. I've never speculated in it. And I kind of feel that I'm good at investing. So why try and get involved in something that you don't understand? You're better off sticking to what you know. And I'm trying to learn about crypto, but I can see the opportunities in blockchain. I can understand why there's all the hype about it, but I think a lot of it's hype. And I don't know what the right price for Bitcoin is. So I won't be buying it anytime soon. But that's not to say that other people shouldn't. It's just to say that for me, I don't like owning things that I don't understand and can't value. So the only thing that I can't value that I own is gold. But then I figure that there's 5,000 years of history, and I know that people like gold.
I love it. And, it's interesting, I'm writing a new book and it's called The Laws of Wealth. And law number 3 is protect your wealth. And law number 3 goes into exactly what you just said. It's invest in things that you know, like, and understand, or invest in people that have a specific skill set that they've developed over time with proper knowledge, proper wisdom, and potentially failure. Because if they haven't failed, they don't know what those risks could potentially be. So you literally just took the law number 3 and described it as to how you invest money. And it's interesting because through all my studies of history that goes all the way back to the times of Babylon and probably before that, that all the same laws have applied throughout history, and they always will. And that's why I'm so excited about that book and so excited to have you on, because everything you say just fits so in line. Maybe not the treasury part, but again, I'm just doing a short-term play on that. So the other thing I just want to make sure we come back to is, number one, you're an author of The Smart Money Method, How to Pick Stocks Like a Hedge Fund. So folks, make sure you check that book out. But you also teach people this with your Behind the Balance Sheet. Can you just spend just 2 seconds on how people could learn more about your teachings and what you have that could really benefit people, especially now more than ever?
Sure, with pleasure. I mean, you can find me very easily. I'm on Twitter at Steve Clapham. The website, behindthebalancesheet.com, has an online training school. We have a number of courses. So we start off, the entry level is, how to do a model in Excel. And we go up through, how to read a balance sheet and read through the financial statements, how to pick winning stocks, how to value companies. And our flagship courses we've got a course called the Analyst Academy, which is a 12-month subscription. It's a lot of material, which teaches you all the skills you need to be an amateur investor in equities. And we've got Analyst Academy Pro, which teaches you, if you want to be an analyst or a portfolio manager in a hedge fund or a long-only fund, we teach you all the skills, including things, like how do you do a stock pitch? How do you write a research note? So you can find all that on my website, behindthebalancesheet.com. And, if people want to have a look and they want to find out more, they can always email me or fill out the form in the website. I'm very happy to help. And
I didn't know you had more than one, so that's great. So you have it for all different levels of investors. For example, like my trader that works in the hedge fund could benefit significantly from the pro version and learn all that stuff. Because one thing I really want to get into is, writing research papers and writing white papers that then, kind of form the basis for how we invest and what we do. So I think Shodi's going to have to go through that course just to learn the things that you do, because there's no other way to get your skill set outside of just learn from you. And, most people, there's only so many hours in the day, so you can't mentor and teach everybody one-on-one. So you've taken your skill sets, your knowledge, and you put it into these courses with, Behind the Balance Sheet. And you also have a podcast, I believe, right?
Yeah, that's right. I mean, it's interesting, the online courses. I mean, one of the things that's I really dislike about the investing world is it's filled with charlatans who will promise to make you rich tomorrow. And I don't promise to make you rich. I promise to tell you, teach you how to value a company and how to look at a balance sheet and all of that. Whether you become rich at the end of it is down to your own discipline. But what I will do is help you form your own investment philosophy. And it slightly upsets me when I think about all these people that are, because I get loads of people come in my course, say, oh, thank goodness we found some. We've done all these courses. We spent thousands of dollars, wasted thousands of dollars. So, what I try and do is I try and offer people a proper education in investing at a sensible price. But the podcast, people just kept saying to me, oh, why don't you do a podcast? Why don't you do a podcast? So I thought, well, last year I thought, I'll do 5 podcasts and see how they go. And so I started off with John Armitage, who's one of the most successful hedge fund managers in the world. Nobody's ever heard of him, right? He's got a $28 billion hedge fund. He's got a 27-year track record, which is astonishingly good. I know, who's he? So I said, John very kindly agreed to come on the podcast. He's going to come on again, I hope. I had Stuart Roden, who was the chairman of Lansdowne Partners, which is one of the most successful hedge funds in London. I did these things where I did a podcast with 2 guests, one from hedge fund, one from venture capital. And we talked about the intersection, because I think that's quite interesting. More and more tech stocks are becoming a bigger part of the market, and looking at tech from two angles, which fascinates me. And so I'm now doing a series of podcasts with macro people, because, you know, as we've been talking, Chris, you know, I believe we're at an inflection point. We've had 40 years of falling rates, and we're not going to have that any longer. So how do we need to think? And so with a bit of luck, I'm doing 4 or 5, probably, certainly 3. I've recorded 2 already. The first one went out last week with Hugh Henry, who is a very well-known hedge fund manager in London. He made 30% in 2008. He described his approach as a cockroach mentality, to be the last man standing, basically, you know. And so we did that. We recorded that in December. That went out last week. I've got another one going out next month. I only do it once a month because you know, it's hard, as you know better than anyone. It's hard work. It takes a lot of time. It's time consuming to do a podcast. But you know, I'm enjoying doing it. I'm learning a lot, and so it's quite fun. So
no, it is fast. It's fascinating. Podcasting is difficult. I mean, we've got hundreds of episodes, and every single one of them was a lot of work. And you know what? It's a very, you know, big commitment you make when taking that on, but I think it's a necessary one, especially in your space, because there's very few people that have that inside scoop to hedge fund managers like the ones you're mentioning that actually can get them on a show to talk about, hey, how did you do this? How did you make 30% in 2008? That wasn't luck. That was knowledge. That was the cockroach approach. So I love it. So I will become an avid follower of the podcast, folks. We're going to put the link for Behind the Balance Sheet so you can look at the courses. I'm going to get my trader in that course so that he can learn the things that Steve here knows, because there's only one way to get that kind of wisdom, and that is get around the campfire. And folks, get on his podcast and listen to this. You might think some of this stuff is over your head. It's really not. This stuff is actually quite simple. You just make it complicated because everybody's always told you it's so hard for you to manage your own money, and it's too complicated to manage your own money. It's only too complicated because you've been listening to the big lie of people telling you you should give up control of your money and give it to them so they can make fees, so they can make money on your money, when you should be a good steward of your money. Learn a few simple skill sets and manage your own money. Get really good at things that you know, like, and understand, and go deep in them. And I bet you any money, can't guarantee anything, but I bet you any money, you will have tremendous success if you just stop giving up control of your money. Steve, thank you so very much for your time today. And I would love to actually bring you on our Wealth Webinar series and our other programs so that you can share some of this with other categories of people and help all of them.
Well, thank you. It's been great fun. I'd love to come on your webinar, so I look forward to that. Thank you again.
Yeah, absolutely. And thank you all for watching. This is another episode of the Chris Naugle Show. I urge you, check out my other videos by subscribing to this YouTube channel. Hey, also, hit that little alerts button right up there. It's somewhere up there. Actually, smash the alerts button so that you are notified every time we put out a new video.
Your job is to make a connection with the client and to have a relationship with the human, not with their money. The relationship with their money is what everybody else is trying to do.